We're going to move on to our next guest and talk about the asset management industry. It's kind of an extraordinary backdrop going on right now. The consolidation, BlackRock buying HBS, Apollo folding an insurance business, Franklin Templeton buying Putnam, private credit firms being acquired right and left. But our next guest, well, she talks a lot about how her firm actually isn't selling, merging, or rebranding. Dina DiLorenzo joins us right now, the president of Guggenheim Investments. Dina, thanks for being with us, and thanks for bearing through some of our technical difficulties here. You can see how the sausage is made here. In real time here. Let's talk about how things are going on behind the scenes at your firm here. Obviously, a ton of growth here, but you've kind of taken a different approach here. You're not really going out there trying to grow inorganically, if you will, or are you?
Well, it's always good to see you both. Thank you. It's been a long week at Milken, but it's been a really productive and exciting week. And, you know, as when we started the week, I feel like we've come full circle, right? We're seeing volatility still in the fixed income markets, but the equity markets are absorbing and resilient and keeping everybody really excited about what's to come. At Guggenheim, you know, we've been around for close to 22 years now. I've been at the firm for about that time. And at Guggenheim Investments, we just continue to focus on delivering the strategies that where our core competencies are, and that's across the fixed income spectrum, private credit. We've just recently, though, launched additional strategies under the private credit umbrella, asset-backed financing, and we're going to start offering some more vehicles and to get access to some of the more, I would say, important strategies under private credit, like structured credit.
Well, I am curious about the asset-backed financing side. I mean, you've talked about this before and the opportunities there. How has that changed, say maybe a couple of years ago? Like if we were having this conversation 2 years ago versus today, what's changed? And I mean, what are clients actually asking for?
I don't think it's more about what's changed. I think it's more about why it's important, right? And to put it simply, you know, there's three types of, you know, income is really important, right? So if you want to, and yield is really important when it comes to the income. So we look at it like private credit, structured credit, asset-backed financing, although they behave differently, right? And the asset-backed financing, and to put it simply, as I was going to say, is it relies on cash versus the collateral of a company. So when investors, especially institutional investors, insurance companies, are looking at asset-backed financing, they're really focused on the cash flows and it's based on the hard assets.
And I do also want to talk a little bit about the product landscape as well. I know that Guggenheim, you know, has sort of re-entered the ETF market. It's an industry that I follow very closely, and we know that it's fiercely competitive there. And I would just love to hear how that experience is going so far, you know, what you've learned at this point.
So at Guggenheim, we really focus on not saying you should buy a product, but more about these are the strategies that we offer, and these are the track records that we have in each of these strategies. And we could create bespoke solutions, or we create, you know, certain wrappers to help you get access to those. We believe that providing the active management in ETF right now is really important because it provides you with the flexibility and the liquidity as well as the transparency. And for just not only retail clients, but also institutional clients like insurance companies, some of the strategies that we're offering are really good for their capital requirements, right? So they like particularly covered call strategies, enhanced equity strategies. We're offering that. We believe that, like I said, I think I talked to Bloomberg in the past about how important we think structured credit is as an asset class. We're going to be offering securitized credit and CLOs in the form of an ETF, which democratizes those strategies that in the past are often perceived as very complex and hard to access. So if you're packaging them in wrappers that provide you with that liquidity and that valuation, there'll be a higher sense of comfort, you know, and accessibility.
Well, I am curious, and I mean, we should point out, I mean, you guys have kind of been, you know, we talk about this rubbing of the shoulders between public and private markets. I mean, that's kind of been your bread and butter. You were doing that before anyone. You were doing private credit before anyone called it private credit.
And I think that's a real differentiator for us, right? I mean, you have the firms that really focus on private credit, and you know, now you're seeing the ones that were really focused on liquid credit, trying to get out there and buy and merge and bring those offerings in-house. I mean, we've been specializing in both since we opened our doors, and the operating model around that is super important because it's not just about generating the performance, it's really about providing the efficiency of the operational infrastructure, right? And that is why you've probably seen some of the reactions with certain, you know, vehicles like BDCs strategies.
Draw a distinction, though, between your underwriting standards and maybe some of the newer entrants into this space, because, I mean, you've seen all the hullabaloo over this. And, I mean, you brought up the insurance companies. I mean, you're doing like $140 billion for insurers right now, which is a different type of capital and a different type of risk profile here. Your underwriting standards, have they shifted at all?
Our investment process is team-based, and we've always had a very strict due diligence process. Like, I'll give you a statistic which I'm really proud of, right? I mean, we keep track of all of the opportunities that are presented to us or that we source ourselves in a very technologically sophisticated system, right? And I would say, depending on the surge of originated transactions that come our way, we look at anywhere between 800 to 1,500 opportunities a year, and maybe we allocate capital to 10% of those deals. It's all about, and this is really important, right? Like right now, our focus is adding duration, like correctly, being very selective on the long end. Underwriting discipline is immensely important, right? Making sure that you're structuring income correctly as well, right? So with our due diligence process, our underwriting savvy, the fact that we've been through several credit cycles, it's quality over quantity is strictly important to us. And we share all of that transparency with our clients. Like, for example, right now with the software issue that most of our competitors are facing, yes, we're exposed to software, but we've been managing that risk. We keep an AI scorecard, right? We are definitely on top of where you're supposed to be investing, allocating capital, and being wary of, some of the yellow flags that may surface.
Interesting. And then I do also want to talk a little bit more about CLOs. You mentioned you launched a CLO ETF, and that really has been a hot spot over the past couple of years as you have these elevated rates. But the idea that they're coming down, you've seen that, sort of start to manifest itself in the form of outflows. And I wonder if that's a concern for you at Guggenheim, or is that just the way the markets?
No, as a matter of fact, CLOs has been our bread and butter for a really long time, so much so that we've actually enhanced the team. We've just onboarded a team from that was previously at Blackstone. They joined back in the fourth quarter of 2025. We're continuing to hire. We just actually announced one of our a CLO that we just, a warehouse that we just launched into the institutional marketplace. And we believe that right now, especially given the uncertainty with the rates, right, the Fed policy, the geopolitical tensions, and really it's not just about, I would say, rate fluctuation, but also inflation. It's real return risk, right? Like, what is the real return based on the yields that you want? And with the CLOs, you really get to access that floating rate structure, right? And then you get those pooled tranches, so you mitigate some of the risk, right? So CLOs, you could buy a CLO and be an equity partner, or you could just be a straight owner of the CLO. So educating our clients, providing that thought leadership, and now packaging those into a retail-like structure, I think is going to be really interesting and differentiate us from the
Is your job harder now in this environment? Is your job hard? Yeah.
I would say no. My job, I love my job, and mostly because I love the people I get to deal with, right?
Yeah.
Our clients have been our clients for a really long time. I have a wonderful leadership team, right? And together, we face these fluctuations, and we know we grew up in this business knowing that you should expect cycles, and we're really excited for cycles because that brings opportunity for us. Where we look for opportunity is in the volatility. So we're excited.